back to our FTSE 100 series. Today we'll be looking at Associated British Foods, Aviva, BT Group, Scottish Mortgage Investment Trust and Aviva. Now you might be wondering, what on earth is there two Avivas here? One's a diversified insurance company and the other one is more on the technological side, an information type company. But we'll be looking through. This was supposed to be Bunzl, but they just eked out Bunzl, and Aviva and ABF actually swapped places before I did this video. Amazing what can happen over a weekend. Now let's jump into it. Associated British Foods, one of my favourite companies. You can see by its snowflake analysis, it scores very, very highly. In my own portfolio, they own Primark and a lot of in-house brands that many people in the UK will be very familiar with, from the likes of Kingsmill all the way to Silver Spoon Sugar. Their dividend yield is 4 out of 6, 4 out of 6 in valuation, 3 out of 6 in future growth, 4 out of 6 for past performance, and 6 out of 6 on financial health, giving them a flawless balance sheet, good value, and they pay out decent dividend. Now, it's a bit unstable on the track record, but we'll look later into that. Ticker symbol ABF, pretty easy. Currently trading at £15.53, with a market cap of 12 billion. Now they are down 18% over the last 12 months, which for me personally means it's an excellent time to cost average in. Unfortunately, during the October phase, where a lot of UK companies were down, I didn't actually purchase many shares at the time. Wish I did, but you know, we can wish on a lot of things. But let's jump into it. They operate as a diversified food, ingredients and retail company. As I said, they own Primark, so good starting place here. 46% below their fair value. They're forecasted to grow 11% per year, and they grew over 46% coming out of all the lockdowns. Good to see. Now, let's nip down here to their bit of information. You can see they were founded in 1934. 132,000 employees, and their CEO is George Weston. We'll be having a look at that later in the video. Pay ratio of 17.4, and we can see they made 17 billion last year. Well, actually, this year. Cost of revenue was 13.2. Gross profit 3.8 and other expenses 3.1, leaving them with 700 million in net profit, giving them a 4% profit margin. We can see their next earnings date is the 25th of April. If you're looking into the stock, definitely a date to certainly remember. Yield of 2.8%, a payout ratio of 49%. Now, they are brilliant on the valuation, and we'll see why down here. Now, why they're put in with Tate & Lyle and Cranswick and Premier Foods is a few of them are technically competitors, albeit Associated British Foods do have a lot of brands. They also do ingredients as well, which is why these guys would be peers or competitors as such. Down to their discounted cash flow model, we can see that they sit at £15.53, fair value of £29.11, which, you know, that makes sense. They were above £20 at the start of the year, weren't they? Yeah, about £21 at a high peak. Good to see. Future growth is forecast to actually go up 11.1% annually. See, Primark, even into a recession, Primark is a brilliant retail side of things to have, and a lot of their brands aren't, I wouldn't say they're super premium, they're just everyday items and essentials. Everyone needs sugar, you know, everyone needs, you know, to buy bread, Kingsmill and all that, so I think they're pretty well placed going into the next couple of years. Free cash flow, they have about 384 million in free cash flow at the moment. Past performance, minus 15.7. They were growing, you can see, quite consistently up until the pandemic for, you know, a lot of companies. We can actually see that they have returned to pre-pandemic levels in terms of both revenue and earnings. Financial health is where they thrive, with 7.83 billion in assets to 4 billion in liabilities in the short term alone, and then almost tripling that for 12 billion long-term assets to 4 billion in liabilities. We can see that they have virtually no debt. they have actually 2 billion in cash and equivalents to 637 million in debt, giving them a 5.5% debt equity ratio, so close to basically being debt free. And if they wanted to, use debt more, if the company was looking at using debt, they have an awful lot of room to do so. More cash than total debt, which is just fantastic. Very difficult to argue with a company that's this financially healthy and forecast to continue to grow. Of course, those forecasts are not concrete, but they are something to keep an eye out on. The debt coverage is well covered, 181% with a 13.9 times coverage on their interest payments alone. We can see the majority of their balance sheets made up of physical assets, inventory, cash, receivables, and long-term assets. On to their dividend, it scores 4 out of 6. Now, it's not high and it's not stable, but we'll see why that might be the case. It's forecast to grow in the next 3 years. And we can see that they were a consistent dividend. Their dividend per share was growing consistently all the way up to the pandemic. And they cut payments for approximately a year, restarting them back in April of 2021. And they are more or less at pre-pandemic levels, just shy of it. And I dare say that if the forecasts are correct, they'll return to a higher dividend per share than even before the pandemic. Now, let's go down here. Cash payout. Management have a 17.7 year average management tenure. That's very impressive, as is the CEO, who's a 23.6 year tenure. That's pretty incredible, to say the least. Definitely. We can go down here and see that both leadership team, 17 years. They say a tenure of 5 years is considered good, so tripling that and then some is fantastic. You can also see that the board are 7.3 years average. Now, in terms of insider buying and selling the shares, there isn't anything over $750,000, just board members. It seems that a lot of them actually bought in the last 3 to 6 months, which is an encouraging sign, of course. Private companies own 57%. Institutions come in at second at 35%. And the general public, in fact, make up 6%. The top one is Winnington Investments. I'm not actually too sure who they are. I must have a wee look when I do the video dedicated to ABF. BlackRock and Artisan Partnership are second and third, respectively. How many employees do they have? 132,000. Nice. Okay, let's jump over to the next one. Aviva. Now, this is the insurance one. Diversified across retirement, investment and savings products in the UK, Ireland, Canada and internationally. Currently trading at £4.36, down 16%. They had a high of about £5.85, lows of almost £3.95. They had a bit of a drop off back there in May of this year by almost £1.50. Their ticker symbol is AV. Okay, moving on to their Snowflake. It scores 4 out of 6 in valuation. That's pretty good. And their future growth is 5 out of 6. That's quite rare. It's very, very rare we would see that analysts all agree that to give, good growth prospects to a company such as this. So we'll have a wee nosy at that, certainly. Past performance, not great. Financially, 4 out of 6. Nothing too bad there. Let's drop down and have a wee nosy, shall we? Does it actually say what happened when it dropped? Looking into some of this, non-executive director, no, let's see. And a final dividend. Something definitely happened in May anyway. Let's go and see here. Oh, they've made a loss. 2.8 in the price to sales ratio. They made a loss. Maybe it was their earnings call. Their earnings call was June. Let's see. What was their stock price towards June? Well, it wasn't that. Bit of a cliff drop. Interesting to see nonetheless. See, and that is, I always advocate, in this game, in sort of the dividend world and invest in general, it's always great to do, a good bit of research. When I look into Aviva, we'll find out why there was such a sudden drop. in May, but again, always something to have a wee look at. Now, down to their valuation. We can see here that their fair valuation is £8.09, currently trading at £4.36. So 46% undervalued using that model. Something to bear in mind. Future growth, 88.9%. Now, of course, because their earnings are in the negative, they're forecast to return to profitability into December of 2022. And onward. Now, if that's the case, it certainly remains to be seen. Free cash flow, 6 billion though. That doesn't sound entirely correct, does it? See, it's because it's in insurance and retirement. There's a lot of factors, interest rates, a lot of things affect this, so it definitely has to be looked at slightly differently to other stocks. Historically, they were doing not too bad up to 2017. Had a drop even pre-pandemic. Survived, through the pandemic, things didn't go all that great for Aviva either. But hopefully their fortunes turn around. Down to their financial positions, again, because of this type of company, you can see short-term 36 billion to 12 billion and long-term 282 billion assets to 291 billion in liabilities. Still maintain a pretty healthy debt equity ratio, 48%. Cash and equivalents, 13 billion. Ooh, they have more cash than total debt. Debt coverage is well covered by operating cash flow, and we don't have the data for interest coverage, but I imagine it should be well covered. Now, 2 out of 6. Their yield is 5.73%, which is higher than the industry average, and forecast to actually grow in the next 3 years. Now, we can see here from 2013 all the way to 2019, they were growing their dividend per share quite nicely. Had a wee bit of a dip over the pandemic, but they continued to pay it, and it's forecast to actually grow into the future. Management has a 2.8-year tenure. That's definitely a bit of a shake-up, isn't it, from the other ones? The average manager tenure, 2 years at this company, is experienced, so okay, but it's definitely far off the 17-year tenure of Associated British Foods, that's for sure. But different companies, different industries, always something to bear in mind. We can see here there's been a lot of buying over the last 12 months inside the company. Now, how many employees do they have? They have, had 31,000 back in 2020, and now they've 22,000. Bit of a cut in the workforce there. Founded in 1696. Got there in the end, didn't we? Anyway, on to the BT group. Now, their snowflakes looking slightly better. More in the value, more in the good dividend pair, good valuation. All right balance sheet, all right past performance, not looking good in the future growth front, so we'll have to have a look at that. It currently trades at £1.13. Ticker symbol's BT.A. That, always remember the .A if you want to find the stock. On a lot of brokerages, for some reason, just BT doesn't cut it. Now, it is down 31%. High of nearly £2 and currently at its lowest point of £1.13. Some people see opportunity in that. Some people, think to stay away. Obviously, it all comes down to individual preference. No financial advice here. Trading at 43% below its fair value, and earnings grew 65%. Trading at a good value compared to peers in industry. Now, there's a few risks for BT here. Earnings are forecast to decline by 2.8% per year for the next 3 years. Not major, but obviously a decline is not great for any company, especially when it's forecasted. High level of debt, unstable dividend track record, and large one-off payments. Okay, let's have a wee look here down at the valuation. We can see that their pay ratio is 6.4. Okay. Their peers, Airtel Africa and Vodafone, are probably the two closest for that. Vodafone beat them in the payee, certainly, as does Airtel Africa, but obviously payee works in the lower it is, the better it is, technically. So that's not too bad. Fair value at £2. I mean, it was almost trading at £2, so I always like to see that a company at least achieved its fair value in the past. But it's still 43% down from that. Future growth, you can see it is forecast to ever so slightly just decline in the next couple of years. Free cash flow at the moment for BT is about 1.1 billion, so they do have a wee bit of a cushion in that regard. In terms of past performance, they seem to have peaked about 2017 and been on a very slow, steady decline since, obviously due to a number of reasons that you'd need to look into deeper if BT was a company you were interested in. 8.7 billion in assets to 9.8 billion in the short term. Now their long term looks better, 44 billion to 27. We can see here that their debt equity ratio sits at about 115%. Not great, but when we throw in cash and equivalents, they've got about 3.2 billion in cash and equivalents, which sort of makes up for that gap in some sense there. Debt coverage is well covered by operating cash flow, and interest payments are also well covered at 4.2. Now their dividend yield is 5 out of 6. It is 6.82%, and which is pretty decent, I must say. It's at least in the market top 25%. It is indeed. It's forecast to grow very, very slightly, and it's far above the telecom industry average. Now, it means their ex-dividend date is December 29th. So in order for you to get that, you need to have it by December 28th. And obviously, because of Christmas and all, a lot of stock brokerages close over a few dates. So it's something you would have to look into. And then it's paid out on the 6th of February. Interesting to see. It has been growing from 2012. It's been growing consistently up to 2017. Stagnated to 2019. Had a wee bit of a dip in 2020. Obviously, no payments were issued between 2020 and restarted back in 2021. And it's grown ever so slightly. It's not pre-pandemic levels in terms of dividend per share. And it's forecasted to just slightly grow. Nothing major anyway. How's management? 4.7 years average tenure. How does that... it's considered experienced. Okay. As are the board of directors. Has there been much ban? One insider bought 1,800 shares, or £1,800 worth of shares back about 6 to 9 months ago. The breakdown here should be interesting. 47% institutions, 18% individual insiders, general public, and then public companies. Wow, that's a really diverse, breakdown of ownership. The top one is Patrick Draha, Deutsche Telekom AG, BT Group, Shareview Clients, and BlackRock and Vanguard are in the top 5. Cool breakdown to say the least. Currently employing 98,400 employees. Okay, now on to a company that I'm not all that familiar with, the Scottish Mortgage Investment Trust. You'll see their logo in the thumbnail was actually Gifford and Co., which are the ones that manage and launch this closed-ended equity mutual fund. What do they do? Well, we're going to have to read into it and have we nosy here. It invests in public equity markets of countries across the globe. The fund seeks to invest in stocks of companies operating across diversified sectors. Okay, not too bad. Decent enough explanation, I suppose. The Snowflake, it's not actually letting me see that much on it. It's slightly good in value, and that's where pretty much ends. Financially, the balance sheet doesn't look that great. Past, future, and dividend performance, it's also down 44% from a high of £13.29 back in December of last year. It's now down to £7.37. A ticker symbol of SMT. Okay. Now, obviously, because this is what's PB's the price to book ratio 0.9. Book value 12 billion, market cap 10.46. I mean, I'm not too sure for a close-ended fund if that's a good thing. And in terms of data, there isn't a lot to go on for this. It's forecast to grow by 9.7%. Again, not that much data. It seems to, for Simply Wall Street anyway, it seems that Scottish Mortgage Investment Trust isn't very... is it... it's not that one, is it? No, this isn't... this company's no longer... No, it is SMT. So there isn't an awful lot to go on. I'd be very curious if anyone in the comment section knows much about Scottish Mortgage Investment Trust. It's in the FTSE, but clearly there isn't an awful lot to go on. Oh, we can get some financials though. Decent debt equity ratio. What do they have in cash and equivalents? 233 million. I'm very curious to see if they even pay a dividend. 0.5%. Oof. Have they been paying that? They've been paying that consistently every single year for at least the last decade. All right, well, got a hand to them in that one. But in terms of their dividend per share, it may be growing, but the yield has been plummeting. So, yeah, something to bear in mind. Definitely. Who owns it? 60% institutions to 34% general public. Rathbone Investment Management, BlackRock, AJ Bell, and Gifford & Co. are the top 4. All right. How many do they have? Do they have many employees? Does it even say? Doesn't even say. Wow. Okay. That was a bit of a strange one. We'll nip on over to Aviva, the second Aviva in the video. What's the chances that these two companies were side by side? I wouldn't have believed it if anyone told me, but ticker symbol AVV. Currently trading at £32, down 2% in the last 12 months. High of about £34. Their lowest point was about £20. Yeah, about £20. Then they had a wee bit of a resurgence back in August, and they've been pretty stagnant ever since. Forecast to grow 43% in earnings. No risk detected. Reasonable growth potential. 4 out of 6, but nothing else is scoring too high. They provide engineering and industrial software solutions globally. Cool. Does it actually give me a wee bit more on that? Yeah, just engineering, construction, monitoring and control, planning and scheduling. Oh, right. They also serve customers in the chemical, food and beverage, consumer packaged goods, infrastructure, and many, many more industries. There you go. The more you know. On the valuation, currently a 7.7% price to sales ratio, right? A few of the peers, well, Sage Group, that's just in our technology company. I don't know if that would be a direct competitor for the things these guys are doing. So we'll drop down to not future growth. We'll drop down and see here for value. 26.6% overvalued on a DCF model. Now, there is intrinsic value and there's a few other models, but obviously this is the one that is on Simply Wall Street, so I just use it as a bit of a reference, something to bear in mind. Let me know if anyone owns any Aviva stock as well, or any of the stock in the video. I'm always curious to see if anyone owns any of these stocks. I own ABF. I'm very familiar with them. Used to own Aviva, but continuing on, we can see here that their revenue is 1.2 billion and earnings is negative 61 million. Forecast to recover though in 2023 and beyond. Historically, past performance, well, their earnings their revenue is definitely up. It has soared. It's nearly tripled from 2017, but their earnings just they had an 8.4% profit margin in 2020. Maybe the pandemic definitely negatively affected them, but they're currently down negative 5%. See if their financial health is any better. Short term, 843 million to 500 million liabilities. Far better in long term, 6 billion to a billion. So 6-to-1 ratio in the long term ones. We can see here that their debt equity ratio is 14%. That's pretty healthy. Nothing out of the ordinary. 203 million in cash and equivalents. Now, their debt coverage is well covered by operating cash flow, but their interest payments are not exactly well covered. They are covered, but again, they apparently Simply Wall Street looks for a ×3 for interest payments to be considered well covered. So something to note. Now, dividend is 0 out of 6. Does pay a dividend 1.17%, which is definitely on the much lower side of things. And it's forecast, just like BT, to ever so slightly grow from 1.2 to 1.3%. We can see here that it's been a little erratic. First payment, is that back in 2018? Was their first payment? All right. Yields always hovered around 1%, 1.4%. The dividend per share isn't growing consistently either, but it is forecast to somewhat recover in the next couple of years. Let's go down to management. 1.8 years average tenure. Surely that must be considered not very experienced. Yeah, less than 2 years. Most of the management seem to be very, very new, to say the least. Replaced probably just in the middle of the pandemic or just at the start. That's something to note, especially when it comes to management. It would raise a few questions and eyebrows for me. Down to ownership. Let's see if anyone has been... Ooh. It's a lot of selling by 18 companies. 2.9 billion was sold in the last 3 months. Even more if you include the last 3 to 6. Public companies and institutions are the two top ownership. Schneider Electric, J. Kennedy, and Davidson Kemper Capital are the top 3 owners. I don't know who Schneider Electric is. I'll have to have a wee look at that there. Employees, they had back in 2017 2,500, and they've more or less tripled their workforce in 4 years. So things are definitely looking pretty good. Obviously, the forecasted earnings and revenue growth, 43%, that is pretty substantial. So yeah, it's quite an interesting and diverse group of companies to look through, to say the least. Now, in terms of who we're going to look at first or next, we're actually going to jump over. I'll show you the next 5. Bunzl, a really good dividend growth stock, but we'll have a wee look at them. One of my personal favourites in the medical industry, Smith & Nephew. Croda Chemical Company, Segro and Informa. I'm not too familiar with both of these, so that'll be interesting how we look through. And obviously many more to come. I'll catch you all in the next episode. Thank you.